Where is the smart money going this decade? Is it heading towards gold? Is it returning to the equity market? Is it consolidating in Bitcoin? Today, I invited one of the only technical traders that I pay a lot of attention to and want to hear his perspective. It's Gareth Soloway. He's been on the channel many times before, and this is what we debate today. I hope you enjoy. Welcome to VRIC Media, the most trusted voice in the metals and mining market. Here's Gareth.
This is Jay Martin.
All right, here I am with Gareth Soloway. Gareth, it's good to see you again, man. It's been a while.
Great to be here, Jay. Great to talk to you again. Thank you.
Okay, so I want you to help us today navigate what is unending volatility, but I just want to pick your brain for where you're seeing opportunity and threats, and maybe we'll go market by market. I want to start with gold. I also want to get your thoughts on broad market and crypto, Bitcoin. But let's start with the gold rally. You know, if we had heard that we would be seeing today's gold prices 6 years ago, we would have assumed a very different equities market for the miners, right? That hasn't really materialized. But sticking with the metal for the moment, you know, how do you interpret this rally, the recent pullback? What's it in response to, and how do you process that, Gareth?
Yeah, so I think ever since we got into this year, 2025, I think gold has been the best performing asset when you compare it to Bitcoin or to the stock market. And I think that's really the fear trade, right? It's the store of safety where we've seen this kind of weird dollar treasury movement away as a store of safety that's been historically kind of where money runs to, and it doesn't leave much else besides gold. And I think that's really been one of the driving forces with gold right now, is that we've seen, again, the safe havens be limited to mainly gold. You could argue Bitcoin slightly. We'll talk about that in just a little bit, but I do want to show you here because, believe it or not, as bullish as I've been on gold for a long period of time, I did go bearish in the near term just over the last couple weeks. And I want to show you why. So we have this beautiful parallel, and these parallel trend lines, something about it when you have a parallel line which marks the lows here going back to 2018 and then this low right here in 2022. And as we can see, when you put that in and you stretch it up, look at where the market ran into the 2011 bull market high. If we zoom into that, that's where gold pierced and immediately pulled back from. And that, to me, on a technical basis, what it extrapolates into is that there was a short-term maximum greed that was reached, kind of a blow-off top in the near term. And I actually expect gold to pull back here in the near term, probably to about 3150, maybe even retest 3000. So just kind of interesting. And I want to be clear, and I always like to say this, is that I was a big gold bull over the last couple of years. I'm still mid to long term a big gold bull. It's just I'm also a trader. And so when I see a top, I'm going to use it to my advantage to either pare back my position or even short in the near term and then go long again for the next move up.
Yeah. Okay. I appreciate that. And even a pullback to 3150, a pullback to 3000. It's amazing because I can already see the Twitter sentiment erupting over this, when in reality, those are fantastic gold prices if you're in that business.
Oh, yeah.
I
mean, if you think about this, right? A couple of years ago, we were sub 2,000. If you had told any gold fan that they were going to be north of 3,000 in a couple of years, they would have been ecstatic about it.
100%. Okay, I want to pull on one thing you said here. You kind of summarized a move away from treasuries into gold. That's one of the drivers. How do you process that? Is that you're moving to an international asset versus a centralized one? Is this just the geopolitical chessboard being reshuffled and reallocated? What do you make of that move, Gareth?
So I think what's going on here is we have Trump as the president now, and he's not afraid to ruffle feathers, and we've seen that, and I think everyone knows that. And so he's obviously initiated multiple trade wars, China, Europe, all of these other countries, where he's just said, hey, listen, we're going to levy X amount of tariffs on you unless we get exactly what we want. And there's a lot of countries out there where, in a weird way, it's kind of created a scenario where, hey, listen, we don't want to be buyers of treasuries. You know what? We're going to punish the U.S., if you will. We're going to steer away to other assets and buy those assets instead of helping keep the U.S. dollar and treasuries and the U.S. as strong as it has been historically. So I think there's a little bit of a fight back from a lot of these other nations that buy a lot of the U.S. debt. And that's why we saw when the stock market was collapsing, if we look at the chart here, usually when the stock market collapses, yields go down. And we saw yields going down here. And then once the stock market really collapsed, because of the trade war, because of Liberation Day, all of a sudden yields surged to the upside. And I think that's one of the straws that broke the camel's back with Trump saying, okay, he's going to back off on Europe and some of these other countries and kind of bring it back down from 50, 60, 70% tariffs back to, let's say, just a minimum of 10%, because the bond market actually forced him to. Because again, these are the borrowing rates for the US, and we have to refinance $9 trillion in debt this year alone. And needless to say, higher rates don't help the economy. They basically stall the economy. Remember, the Fed raised rates to slow the economy down and bring inflation in versus lowering rates when we get into a recession to stimulate. And so this really put the president in a tough position where he had to say, hey, listen, maybe I need to back off a little bit because these other foreign entities may not be buying our debt like they once were.
Right. Okay. Thank you for that. So let's push into the equity market right from here then, because, seems like this was Trump's scorecard for his entire first term, right? Every day in office, he'd point to the equity market as the scoreboard of whether or not he was doing a good job. And if you use that as the metric, he was doing a good job. He's not doing that this term. It's early days, sub 100 days. I think the 100th day is to Thursday. People might be watching this on Thursday, but it's right here. We're pretty much 100 days in. Okay, let's use that. But the market has not performed. It hasn't been a scoreboard that's validated anything he's done, which is fine, but it's very different from how he approached his first term.
Yeah.
What's your assessment there, Gareth?
So he definitely has stated, and we've seen it, that at least initially, and I'd say the first 80 days, it was very much like, listen, the stock market will do what it wants. No big deal. We're going to do what's right, what we think is right for the country, the U.S. The interesting thing is, when we saw the stock market on the S&P collapsing like this and yields were shooting up, he did kind of back down a little bit there. And that's where he gave in on the tariffs on everyone but essentially China. And so I did think he's really talking this firm game because he wants the markets not to be believing that he's always going to bail out the stock market. But when push came to shove here and the S&P was trading down on April 7th at its lows down, let's see what that was. I mean, that was a massive decline in a very short amount of time from the all-time highs, 21%. He did kind of back off just a little bit. So I think, again, he's trying not to look at the stock market, but inevitably, if the stock market keeps going down, he does still view that. And I think, in all fairness, it's hard for someone who has based their career, their first presidency on the stock market performance to totally then say, oh, well, we're not going to go with that this time. I still think there's some part of him that caters to performance in stocks, probably because he's had so much invested over the course of his life, and he realizes how much the stock market depends on the wealth of the country, the wealth effect as we know it.
100%, and how much it drives sentiment and support for him. And, one thought I've had is that he can afford to be a bit reckless. Well, not reckless. He can afford to not be overly concerned about the performance of the market right now, but come to the midterms, that's a completely different scenario. Right. And it makes me very bullish on the equity market. I expect a roaring market by the time the midterms are here, strictly for that reason. What do you think about that thesis and assumption?
I think as long as he backs off sooner than later on these tariffs, then that's a possibility. My biggest concern is that the tariffs, every day that they last, are doing major damage to the economy, right? So we already had an economy that before tariffs were imposed were kind of stalling out a little bit. We were starting to see little signs of weakness creeping in, consumer spending pulling back. Now we've seen consumer spending almost come to a halt. Even today, I heard Amazon saying, hey, we're going to start itemizing, how much the tariffs are on our goods so that people can see. And that's going to be very unpopular for the government. In fact, the president's administration kind of ripped Amazon because of that, because they don't want that to be what people that are buying things on Amazon are seeing as well. But the idea here is that the U.S. has been in an expansionary period because of monetary easing and government spending now since really 2009. I mean, we've had little blips along the road, but most of it's been due to the Fed tightening in 2021 into 2022 versus a real recession that is not caused by tightening of the Fed. And my concern is that if we're already teetering on that, how much has to occur here before we dive into a major recession where people are just done? And I think that's the bigger thing. And one thing to keep in mind, a year ago, the middle to lower income were already in a recession. It just hadn't spread to the middle upper income because the stock market just kept going up and the wealth effect was there. Well, now we have a stock market that is down off of its highs. We haven't made a new all-time high since January, really. If this continues, does this upper echelon start to stall out on consumer spending? And for the U.S., that's the driving force of the economy.
Yeah. Okay. So to recap thus far, gold, you're still bullish mid to long term, but expecting a short term correction, and that's effectively the greed trade to an extent here. Yeah, lots of opportunity for profit taking. That makes sense, and I'm actually like super aligned with that. Nothing goes up in a straight line. I'm a long term gold bull this decade, but there's going to be massive volatility along the way, of course, because of the multiple forces that drive price. Equity market.
Yes, and sorry, I just want to jump in there. I want to show people a chart here, and this is one of the reasons. So on the equity markets, just to be crystal clear, and you might have been just about to say this, but even though we're bouncing here, I don't believe that this is a long-term bounce. I don't believe we're going to see new all-time highs. I actually think we're going to see new lows, new 52-week lows. Maybe not till summer, but I do think it is coming, and the reason for that comes from the charts. And I want to show you a couple things. Before I do that, I just want to point out a couple stats. In 2008, 2009, we had, I think, 12 bounces during the Great Recession of over 10%, and we still went lower each time afterwards. So when people look at the bounce we've seen in the S&P recently, it's been a great bounce, but this is very common for bear markets. In the dot-com bubble, there were 10 bounces of 14% that occurred while the collapse was occurring. So one thing I say to all my traders in office is that when you get bounces in a bear market, they're called rip your face off rallies, which is if you try to short them too early on, you literally get clobbered. They're so violent to the upside. So just keep that in mind. The other thing I want to show you, this is the S&P logarithmic chart. And this has me thinking that this is a bigger event than just a run-of-the-mill recession if we go into it. What I do here is I go back to 1929. So this is the pre-Great Depression high on the stock market on the S&P. We take a trend line and we connect it through the dot-com high, which was right here in 2000. And what we see is this is the third time now in basically 100 years that we have hit that line. Each time we have hit that line, it hasn't just been a small pullback. It's been, in this case of the dot-com, it was over 50%. And we know in the Great Depression, it was about 80%. And so there are things in the charts that are telling us that this time is in fact different than the run-of-your-mill recessions and could even be much, much more. Now, I'm not going to go as far as to say Great Depression, but could it be something in line with a dot-com collapse, 50% or greater on the S&P? I actually do think that's possible. The other chart I want to just show you here is the NASDAQ composite. And this has me thinking, again, the NASDAQ is at least going into the 13,000 marker. So if we zoom out on this chart, this is, again, a parallel. It's just like gold. Just like the gold chart I showed you, parallels are amazing at predicting highs and lows. Here's your COVID low in 2020, and here's your bear market low in 2022. That parallel, if you take that line, so all you're doing is connecting the parallel, the low from COVID and the bear market low from 2022, you stretch it up, and what we see is it goes exactly to the highs of the bull market and the exact high that we hit here in 2024. So 2021 bull market, 2024 bull market. To me, this tells me if each time we hit the line, we come back to the lower end, at the very least, the NASDAQ needs to come down to this level around 13,600. And that, to me, if we do a measurement on that, even from where we are, that would imply another 22% downside at minimum on the NASDAQ. Just to get back to that trend line. So it's just interesting how these charts are telling us something. And again, my job is just to look at the charts and say, okay, what are the probabilities here? And in this case, the probabilities are that this is more than your run-of-the-mill just pullback or mini recession.
And so staying on this chart, tracking that trend line, that's how you get to a 52-week low, maybe by the summer. Just
correct.
Projecting this forward. Yeah,
exactly. So you basically have, if we just game this out here with an arrow, maybe a little bit more upside, we'll see, and then eventually a downward move, maybe double bottom bounce right there. You get one more up, and then eventually down into that level there. And again, it's important to note markets don't go in straight lines. They tend to, fall, bounce, fall more, et cetera. But this would kind of put us out to midsummer to late summer, potentially into that level.
So what's the scenario? What's the reality of that scenario? Because as you mentioned, despite not being declared a recession, it's been a recession for the lower and mid class.
Mhm.
We tend to wait for a definitive answer from a podium to determine, but it's like people are living it. You know what I mean?
Yeah.
However, it's been clouded by equity performance because you can look at the scoreboard and say, no, like we're growing, things are up, people are making money, this is good. Earnings, all of this stuff. It doesn't impact, the majority of the population, but it's still there in everybody's face and they can feel better about it, for whatever reason. If that changes, that's a seismic shift, culturally, right? And obviously economically. So, what would you expect in terms of response, Gareth? We're midsummer, equity markets at 52-week lows, trade war still raging. There's, all kinds of reshuffling outside of the United States, countries trying to decouple themselves. It's a wild world, right?
It is.
How do you position and what do you anticipate in those moments?
Yeah, so I mean, there's so many possibilities. The one thing I would say is that, let's say the Nasdaq falls down to this level around 14 or high 13,000, I would expect the trade war to be basically done by that point, and that could create a massive bounce. And you might say, well, if the trade war goes away, does everything go back to normal and we're growing again? And the answer is no, because you're doing major damage to not only supply chains, but also to the psychology of the consumer. And I think this is going to be key is, we're so used to the stock market bouncing back within 6 months to new all-time highs.
Yeah.
If you get down to that point, all of a sudden we're at that 6-month barrier. And the question is, do we start to rally back up? So I think, again, eventually the pressure from the stock market will make Trump pull back from his trade wars. Now there will be a claim of victory. There's no doubt about it. He has to save face. And this is every world leader. It doesn't matter if it's one of our past world leaders here or someone around the world. No one wants to be like, oh, the market forced me to do this. I'm at the mercy of the market. So it'll be a claim of victory, like, oh, we got this concession. But ultimately, it makes the trade war go away when the stock market puts enough pressure on it. From that point on, it's going to be a reality of U.S. debt issues. How much damage has been done to the consumer? Will the consumer start to go spend again to that point? Where are interest rates and inflation, right? So how much inflation is in the system from the trade war? And does that magically just go away, or do magically prices now stay elevated, right? I mean, that's the biggest fear for me is that, all right, so all these companies are going to have to raise their prices, let's say by 20%. But we know, and I know this from gasoline stations, right? How fast do those prices come down when gas comes down? Really slowly, if at all. And
If
so
at
you
all.
wonder how
Yeah.
much of this is going to be inbred in the system. And if you jack up prices after what we've just gone through in the last few years of inflation, there's going to be additional massive damage to the lower and middle income. And then even the upper income, unless the stock market's hitting new all-time highs, they're going to be very, very fearful about potential further issues out there. And so I think this is all the catalyst for why, while we could bounce at key levels, I think we're in for a long sludge of hardships.
Well, forces that drive prices up, like inflated input costs, all of this stuff, are very strong. And eventually, corporations have to respond to that by increasing prices and passing that on to the consumers, or that's what they will always do. Forces that decrease prices are far more ambiguous. And if the input costs decrease, but precedent's been set at a higher price point, that's potential margin that company can now capture. And so they have to balance that with consumer demand, right? And competitor pricing and all this stuff. But there's way more at play. And so do prices come down much slower, if at all? I mean, that's it, right? Because once you've established the new precedent, you're going to defend that if you can, as if you're protecting your shareholders' interests and your earnings and all this stuff.
And I also think it's a matter of, you look at how fast wages, at least in the U.S., have really come up. But also we had this great glut of money from the government because of COVID. But all of a sudden, that spigot is starting to be turned off a little bit, at least for now, from Doge and from these other situations, which really, if you turn off government spending, it almost works like the Fed hiking interest rates, where it should slow down. It's stimulus. So it slows down the stimulus push. And that can be something that drags on unless the U.S. starts spending ridiculously again, which then brings up a whole new can of worms, right? Where the U.S. debt starts going up crazy amounts again.
Right. But I'd love to know if you have a assumption or forecast on that.
The forecast is that it's hard for, what do they say, a tiger to change its stripes. So the
Yeah.
U.S., we have a politics scenario where politicians generally have to be revoted every 4 years or so, and they always are incentivized to make things great in the short term so they can get reelected. They never have an incentive to make sure in 50 years that these country is good.
Yeah.
Unfortunately, that means that they're more apt to, when things get hard, they're not going to be hard on those things to keep them in line. They'll slip. And therefore, I unfortunately think the U.S. will go back to spending ridiculously until the rest of the world makes us stop.
Ooh, okay. Okay. I like it. Well, let's move to another asset that the rest of the world can buy then. We touched on Bitcoin very slightly at the beginning. What do you make of this asset relative to gold, relative to equity markets for the time being?
Yeah, so you have to be impressed with Bitcoin over the last month or so, right? So the stock market collapses in over the last couple months. Obviously, the stock market's bounced recently, but the Bitcoin price action has been very solid considering it's usually a risk asset, and usually it drops, let's say, 2 or 3x of what the S&P or the Nasdaq drops. So yes, it was off of its all-time highs up here, but I've been very impressed with the price action. I do think that part of the price action is that when when you have what's going on in the US going on, and people don't want to buy the dollar as a safe haven asset, or they don't want to buy treasuries, well, there's not a lot of places left to hide your money. Gold is one, but there's probably a percentage of money that's moving into Bitcoin at the same time. And so I think that's been keeping it afloat here while the stock market's been a little trickier. It's not to say if the stock market really goes into free fall, we won't see Bitcoin collapse again, because again, panic is panic. But I think it's showing signs of that longer term safe haven asset that we all hope it does become.
And if it does become that, one of the outcomes would be massively reduced volatility, I would expect. Is that
Yep.
correct?
Yeah, and you've already seen that, right? I mean, while these moves are big, if you go back to 2021 or 2017, the volatility is slowly drying up. It's still great volatility, but you're not getting the 1 day swings of 20% in Bitcoin at this point, which is good, because if you want to attract more people to invest in an asset, you can't have 20, 30% swings in short periods of time. That's just too risky for most people. So you got to get the risk out of it a little bit and then make it more like a steady, like a dollar or a currency type scenario.
Yeah. So we're seeing that. And you're right. More larger institutions are turning their head, right? Cantor Fitzgerald entering in a big way. So therefore, like midterm, Gareth, would you expect more sovereign participation in this asset class as maybe a smaller but an alternative to U.S. Treasuries and gold?
Yeah, I do think so. I think this becomes, I still think gold is the dominant force at this point for the next 5 or 10 years. But I do think, again, slowly the percentage of sovereign ownership in Bitcoin starts to inch up a little bit, especially as it establishes itself. And more so than anything, the fact that big players like BlackRock and Cantor and these other players are getting involved, that, believe it or not, a lot of the heads of these other countries look to some of those bigger players and say, wow, if they're willing to do it, then it might be something that I want to look at as a country or as a leader of the country and maybe do it as well. So I think, again, it's still not quite at that point, but if you look at the next 5, 10 years, I think absolutely that happens.
Yeah, certainly. Okay, that makes sense. Actually, I don't follow the Bitcoin market nearly as close as probably a lot of my viewers and yourself. Has Goldman Sachs made any moves into the Bitcoin space that you know of?
Not in terms of direct ownership that I'm aware of, but I think it's important to know that they have so many channels and back dealings that if they wanted to, there's no guarantees that we would know, right? And this is the one interesting thing, right? If I'm a $100 billion institution or bigger, I probably don't want to announce that I'm getting into Bitcoin until I've accumulated everything I want in Bitcoin. Because once I say that, then a lot more people follow in, right? And you get that kind of, leader and laggard effect of price.
Yeah. Okay. Because I know it's been interesting to watch countries approach Goldman. They've effectively opened up an entire new business arm consulting with countries that are trying to navigate the U.S. tariffs. Yeah. And, that's it's very opportunistic, but it makes a lot of sense. I mean, they handle the banking for so many of these multinationals that are either looking to reallocate resources, relocate manufacturing hubs, repatriate capital, all this. And their message across the board thus far has been pacify the president. That's what effectively they said to South Africa, to all the countries and multinational corps that have approached them and said, how do we deal with this? And the response has been, be nice.
Yeah.
Be nice and make them love you, right? Which is
exactly.
Okay. So gold's still the predominant alternative choice for the next 5-10 years. Bitcoin maybe building more market share from a sovereign standpoint. Walk me through the defensive portfolio, Gareth, right now, positioning. If you're just looking to not looking to capture volatility to the upside, you're just looking to preserve purchasing power and weather a storm. What's that portfolio look like right now?
Yeah, so for me, and I'll just speak from what I've been investing in and kind of positioning my portfolio. And obviously, I do a fair amount of shorts when the market is right, but more so on the safety side for myself. Like I'm into finding these dividend paying stocks like a Pfizer. Pfizer, by the way, having a great day today on the back of earnings. But when I look at a chart on Pfizer and I see it's beaten down, trading in the $20 to $25 range down here. And it pays a 7.5% dividend yield. So if I put my money in a CD, maybe I'm lucky to get 4%. At a beaten down level on Pfizer, it's paying me 7.5% on the dividend. So I'm looking at these beaten down names. Another one, like a lot of these biotechs have been forgotten and left for dead. Biogen, they don't pay a dividend, but again, it's just been beaten down where it's trading at a forward PE of about 7 to 8. And so I'm much more scared. Like the way I look at things is the big cap tech, like an NVIDIA, if the economy slows down, they're going to take a hit. Like companies are going to pull back on their CapEx and it's going to hurt their bottom line. Their earnings are going to go down. Their multiple has to, their stock price has to adjust. A name like Biogen or Pfizer or Novo Nordisk, they're in the drug business. Like, can people that have high blood pressure just say, oh, I'm not going to take my blood pressure anymore? Meds anymore? They're going to have to take it. And so you're getting a lot of these biotechs at low PE ratios historically and also paying dividends. And it's also something that's really recession proof in terms of the drug side. And so that's more where I'm positioning to maintain buying power or capital versus risking it in the market. The other thing I'll just mention, I think that we're in a monumental shift in the market away from U.S. assets. And we're seeing this with the Treasury and the dollar, right? So that's kind of the beginning stages. But a lot of money is now saying, wait a minute, things are overpriced in the U.S. and very underpriced in other areas of the world. And so one of the charts that I'm loving here is the iShares MSCI Brazil ETF. I mean, look at this classic wedge pattern here, beaten down from, this is the 2008 high. So think about the U.S. stock market, where it is compared to the 2008 high. I mean, you can barely see it. You're on a mountaintop from where we were in 2008. But here, this is way beaten down. And so this is, I think, rotation of capital is what's happening with smart money or essentially institutional money. And I want to get involved in that to a small extent in my portfolio as well to get that exposure to other markets. And this EWZ chart looks great. China, I am liking China, but it's a little riskier because of obviously the trade war and, does it escalate, et cetera. But I mean, same kind of deal. You zoom out on the chart. This was your high on the K-Web back in 2021. And this is where we are right now. And the K-Web is the internet stocks in China, like Alibaba and Baidu and those type of names. So for me, at least, there's a few stocks here and there, but for the most part, it's safe haven, low PE, dividend payers, and then a few little risky spots where I'm investing in overseas assets.
Okay. Thank you for that. We touched on gold, but not gold equities. A couple companies like sort of best in class are hitting 52-week highs, in some cases all times. The majority of the market not totally responding. John Paulson recently bought out VRIC's 50% share of the Donlin project in Alaska for, he put down $800 million, partnered with Thomas Kaplan for another, it looks like 200, but $1 billion transaction there. And that's very interesting. That's both VRIC capitalizing on gold prices and Paulson looking for a 10-year trade. What do you make of the gold miners equities right now, Gareth?
Yeah, so believe it or not, just like gold, I'm short-term bearish, but
Okay.
long-term or mid-term bullish. We could see, look at this. This is the GDX, so this is the gold miners ETF. There's this trend zone right here that connects these highs, and we went right into it right here and pulled back, and we were extended short-term. This right here would be considered what we would call a bear flag, and so it's likely going to have a dip. And so for me, I'm going to start to look to accumulate if it gets down to about 46. Maybe a little lower. I would probably start a position here at 46 and then add around 43 or 42 at this trend line. I still like it. Like, I think the miners are in now. You know, we all know that the miners were forgotten for a long period of time. I mean, if you were a miner investor for years, you were like super disappointed while tech just rocked the house. I
Mhm.
think that's shifting now. I think precious metals, rare earths, those are the things that will be key in the future. Because again, as we've talked about, sure, Doge is trying to cut spending, but in reality, you know, these governments that want to hold on to power and to look good, they're going to probably have to go back to what has been stimulative in the past, which means fiat currencies getting printed, and essentially diluting the value of these fiat currencies. What will maintain the value is gold, silver, platinum, palladium, rare earths, stuff like that. We're even seeing, like, you know, REMX is a nice ETF that you can see here. This is the rare earth and strategic metals ETF. And it's actually, I mean, it's been beaten down. It's starting to show little signs of life. But, you know, these are areas where I do think it's worth on pullbacks picking up some.
Yeah. And just for context for my audience, walk me through what, when you say short term, when you say midterm, when you say long term, what's the vague brackets that you layer on top of that?
Yeah, that's a great question. I'm glad you brought that up because it's probably not clear to a lot of viewers. So for short term, it's literally like 1 to 2 weeks out. Like,
Mhm.
it's me jumping in a short trade off a level, looking to capitalize on a 5-10% pullback in the GDX, and then being done with that trade. It was overbought. We got our retrace. Now the bigger picture, which is going to be anywhere midterm, would be like, you know, anywhere from, let's say, a month or two to 6 months, and then long term is 6 months to multiple years out. So it really, you know, mid to long term, it's just more in this shorter term period where a trader can make money for these quicker trades, but then the longer term trend essentially gets back to work.
Yeah, got it. So short term, sub 1 month,
Yeah, exactly.
midterm, 1 month to around 6 months. These aren't binary absolutes, but that's the generality. And then long term, 6 months plus. I love it. Okay, good context there. Now, you touched on the defensive portfolio a little bit. I'd love to ask you the sort of, other side of that question. If you're feeling lucky and you want to go for some gains, where are you looking for volatility right now to the upside?
Oh, wow. That is a good question. There were a couple trades earlier this week that I liked, and they've already run a fair amount. But I think you go back to kind of what's been working in the past that has been beaten down. So, you know, if you're really looking for those quick gains, and to be clear, I'm not in these names right now, but like, you know, like a SoundHound, the going back to the mega computer, the computing type side of things, quantum computing stocks, these have all been beaten down. You might be getting a little bull flag here for a pop to the upside. Again, I don't think it's going back to the highs anytime soon, but could this run back to $12 or $13, which nets 20 to 30%? I do think that's possible. And then other ones, you know, you have Rigetti, RGTI, same kind of deal. Some old trend lines on that chart, but essentially it's kind of flatlined here. If it can break above some of these recent levels, I think you get a little bit of a pop. But again, you know, for me, I'm not in them. But that would be where, if I had to pick something, I'd probably be looking for bounces on those.
Okay. So using the short, mid, and long-term frameworks, when we're looking at the gold sector, you're expecting short-term pullback. You
Correct.
said you're bullish, medium to long-term. So inside of that time frame, you're bullish on that trade.
Yep.
Love that context. Equity markets, could I make the assumption that short-term you're bearish, medium-term you're bearish, and long-term, any extra pieces of information to share on that, Gareth?
Yeah, that's good. So that's a good point. So here I'm just bringing up the QQQ Nasdaq 100. So we've obviously had a big bounce in the Nasdaq 100. We're kind of right up into this gap fill, which is going to be gap fills in technical analysis are generally resistance levels when you come from underneath. The market here closed this day. It opened the next day down here. That creates a gap. when it's filled, it's usually resistance. So this is kind of my first target where I'm starting to get nervous on the markets in terms of upside versus downside, favoring downside. In general, short term, I would say neutral to bearish. Midterm, I still think we're going a fair amount lower. So we're talking 1 to 6 months. We go down on the NASDAQ 40+%, I think, into year end at least. And then longer term, long term, if you're talking a couple years out, I think it's going to be a sludge. I wouldn't be surprised if we have what we call a lost decade, which is where the stock market doesn't make a new all-time high for as much as 10 years. Now, people look at me like I have 10 heads when I say that, but it's not super uncommon. Like if you go back on the NASDAQ to the dot-com era, when we put in that top in 2000, the year 2000, and I got to go to my weekly to go back, but that's what happened. The dot-com bubble collapsed, and then it took us 15 years to make new all-time highs. Mm-hmm. And so it's not to say, and I want to be clear on this, is that just because we don't make a new all-time high doesn't mean there's not incredible money to be made. Because if you drop 50%, you might bounce 30% and still not make a new all-time high. But you bounce 30%. So there's a huge amount of opportunity within that period. But I do think we've pulled forward a massive amount of the upside in this market with all the stimulus, with all the liquidity, with all the Fed intervention and everything like that. And we're kind of due for one of these periods where it's just we get into this kind of choppy market, which can be great for swing traders and shorter term investors, but maybe isn't great for the long-term 401k investor.
Yeah. And you're right. It's important to pull that chart back to 2000 to have a look at that like recency bias is really powerful. And if you've been conditioned to believe the market will perform a certain way for 15 years, right? Since therefore it's very rational to expect the same in the future. That's a rational thing to think. It's logical, right? Because 15 years is a long duration.
And there were so many investors that came in around COVID, right? We saw a mass inflow. That's where Robinhood became super, super popular, these newer, younger investors. And they've really been conditioned to think that while the market may drop 20, 30%, it'll go back to new all-time highs in 6 months, right? That's what we've seen. So I don't blame them. But in reality, when you look at a bigger sample size and you go back 30, 40, 50 years, there have been periods where the markets have these incredible bull runs, and then it takes 10 plus years to make new all-time highs.
The way you look at a chart, it's like cropping a photo. You can crop a photo and get incredibly different context from the big picture. Very important to look at the big picture. I appreciate that. And your parallels, right? You said, 12, 10% bounces in the 2008 crash, 10, 14% bounces in the dot-com crash. Great context how these things can look in the short term.
Yeah. And that really, again, if you're someone like me that's a shorter term investor, we've actually, I've done well, but the market has been in such a long-term bull grinding up market that it's actually been harder for us shorter-term, mid-term investors versus longer-term investors. It's just been amazing since really 2009. Mm-hmm. But I think we're getting into this cycle where it'll be much more volatile on a normal basis, which means, we'll get 15% drops and 7% bounces, and then 20% drops and 10% bounces. And so if you're a more active investor, it's going to be a great environment.
So you mentioned the overpriced assets in the United States, especially relative to the underpriced assets in some emerging markets. And this could be somewhat a reversion to normalcy or more logical valuations. Maybe investors should think about that. Maybe they should look for yield as opposed to just speculative value, which might dry up in the near term. When I think about, so I don't really play in the broad market. I stick to the arenas where I have a competitive advantage. For me, that's precious metals, but I, like to understand the bigger picture. When I think about your gold thesis, I say, there's some companies that were participating in the rally of the metal itself, but most of them didn't. And so, those are the companies that I'm going to look at who may still pull back. Look, if gold falls from, down to 3,000, everything in that market's going to pull back a little bit, but it's all relative. And again, being familiar with your time horizon, super important. My time horizon isn't a month. It's not 6 months. I'm a bit longer than that because I know my industry. Not quite Hank Paulson 20-year time horizon, but props to that guy.
Well, and the nice thing about it is you get pulled back to 3,000 or 3,150. You just use it as an accumulation opportunity and
There
buy
it
a little
is.
bit more, right?
Yeah, 100%, 100%. I feel quite clear on your equity thesis, and thanks for sharing that. And then just to summarize the Bitcoin concept, as far as I understand it today, like we're I would summarize to say that we're consistently decreasing volatility in that asset, right? And that is why we're seeing bigger money move towards it. The gold Bitcoin like similarities, or I say debates that I've seen occur over the last decade always drove me crazy, because
Me
I'm like,
too.
you have one hyper volatile asset and one that's like the antithesis of volatility. You can't compare these two things, but maybe one day Bitcoin will get to that place where, yes, there's enough adoption internationally with big money, long-term money, that the volatility actually washes out. And then that's a conversation. And I, I'm just to the standpoint of like, I own and have owned gold for a long time for a variety of reasons, but also like non-zero position in Bitcoin has been, in my portfolio for 5-6 years. I wasn't early, but I got there, and yeah, I don't sweat the volatility though.
Nice.
It's like, let's just wait and see what happens here long term. Yeah. Okay. Awesome. If you guys like what Gareth had to say, Gareth, where can we point people to today so they can hear more from you and what you're up to?
Yeah, just check out Verified Investing. It's everything I do is chart data and probability basis analysis, which gives us a clear picture versus people go on social media and then the hype. Everyone's pumping their own book, right? And
Yeah.
then vice versa. And the media, the regular mainstream media, it's narratives. And I've really found a place where for me it works, where I can just do clear analysis based on logic and probabilities. And that's what I'm trying to do with Verified Investing, is make it a safe haven for investors to get probability analysis versus pumping and nonstop nonsense.
Yeah. I appreciate that, man. Okay. Always appreciate your take. You're one of the few technical traders I love having on the show, because you've always got a great perspective, always
Thank
got
you.
tight calls, and I love chatting with you, man. So thanks for your time today.
Thank you so much. Really appreciate it.